Why does a widow usually pay more in taxes than she did when her husband was alive on the exact same income? Most people have no idea this even happens until it does. It has a name, it's called the widow's penalty, and for most married women, it's not a question of if it hits, it's when. Here's the part that catches people off guard. When one spouse passes away, the survivor doesn't just lose a person. The next year, she usually files as a single taxpayer on close to the same income in tax brackets that are far less forgiving. Same money, higher tax, often for the next decade. The good news is that this is one of the most solvable problems there is for retirement. And one of the cleanest tools to soften it is the Roth conversion, done in the right years for the right reasons. By the end of this video, you'll understand exactly how the widow's penalty works. You'll see it play out on a real example, and you'll know whether converting now could protect the surviving spouse later. Let's make this concrete. While you're both alive and filing jointly, you get the married brackets and the married standard deduction. Roughly speaking, you can have about twice the income before you hit a given tax rate compared to a single filer. Now, one spouse passes away. For the year of death, you can usually still file jointly, but the year after that, the surviving spouse files as a single. And here's what surprises people. Her income often barely drops. The pensions, the required minimum distribution from retirement accounts, the larger Social Security benefit of the two, a lot of that keeps coming. So you have nearly the same income, now squeezed into single brackets that are about half as wide with a smaller standard deduction. The result is a higher tax bill on the same lifestyle every single year going forward. And because women, on average, outlive their husbands, the person living through this penalty is usually the wife, often for decades. There is a second layer most people never see coming. Those single brackets can also push her over the income lines that raise her Medicare premiums. So the penalty isn't only income tax, it can quietly raise her healthcare costs too. This is why I care about it so much for the women I work with. You can do everything right as a couple and still hand the survivor a tax problem you never meant to create. So, let me walk you through a real example with real numbers so you can see how this plays out. I'm going to show you in the financial planning software that we actually use for our clients. I've changed clients' names for privacy purposes. I'm going to call them Diane and Paul in this scenario. As you can see, Diane is 59 and Paul is 62. They're still both working. They're planning to retire at the age of 61 and 64, respectively. Together, they have saved about $2.1 million. And here's the part that matters. In this situation, roughly $1.45 million that is sitting in traditional retirement accounts, their 401ks and their IRAs. That's money that has never been taxed before. So every dollar that comes out in retirement gets taxed as income. That's what we're going to focus on today for the sake of, demonstrating the widow's penalty. So in their plan, we assume Paul lives to about 86, which is a little bit above the normal life expectancy for men, and Diane lives to 94 because of the longevity history in the family. And this isn't some worst case scenario where he dies a lot younger. This is ordinary life expectancy, rather conservative, to be honest, with a wife who, like a lot of women, outlive their husband by several years. So watch what happens to Diane's taxes the year after Paul passes. It's one of the biggest jumps after they retired and then started the Social Security income and taken the RMD, started RMD, and both of the RMD starts. And then right here, you can see the jump. So here's the thing that surprises people. Her income barely changes because she was already the higher earner. She keeps her own larger Social Security check. They started receiving the checks at the age of 70, which we decided together. She still has the same lifestyle. Now she's filing as a single person. That same income that fit comfortably before and now stacked into the single bracket, which is about half as wide. Big chunk of her income gets pushed up into a higher rate, which, you can see over here. That increase for the rest of the years is the widow's penalty. And when you add it all up on a household like this one, it easily comes to 6 figures in extra taxes. Money nobody planned for, nobody chose. So here's the lever we have while Diane and Paul are both alive, and especially in those early retirement years, you can see between these years, before Social Security and required minimum distribution kick in, they have the wider married bracket and still a lower income window to work with. We can take some of that traditional money and convert it to a Roth on purpose, a portion each year, filling up to top of a target bracket and no further. They pay some tax on it now, here, at the married rate on their own terms. What we did was filling in to the top of this bracket, which is a capital gain rate being 0%. That's the top of the rate that they filled all up, and then it's no longer taxed significantly right in these years. And then proposed strategy results in $2.69 million more tax adjusted ending assets than the reference strategy, which was prior to putting any of the intentional conversion right in this window. So overall, $348,000 less taxes paid over the lifetime, and then $1.3 million less withdrawals from tax deferred accounts in this situation. And then it helps on the healthcare side too, because lower taxable income can keep her under the lines that spike her Medicare premium. Now, I want to be honest about the trade-off, because this is where the real planning lives. Converting means paying more tax today, and that's money that leaves the portfolio now. It is genuinely hard to pay a tax bill sooner than you have to. So we don't do this to win some bracket game. We do it to protect the person who is going to be filing single on nearly the same income for a decade. For Diane and Paul, that trade is worth it. For another couple, it might not be. The only way to know is to run the numbers on your actual situation. So if you're watching this and you recognize your own household in Diane and Paul, here's where I'd start. Before you touch a single conversion, you want to know where you actually stand on your numbers. I built a free retirement readiness assessment for exactly that. It takes about 5 minutes. It gives you a personalized score and a real estimate of where you are, and it doesn't require an account. The link is down below in the description. If you're farther along and you want someone to actually run the conversion math for your situation, including what it means for the surviving spouse, I offer a free 15-minute Align call. That link is right there too. No pressure, no products. I am a fee-only advisor. That's it for today. If this was helpful, follow Align Your Retirement wherever you listen, or subscribe on YouTube so the next one finds you. Hazel Secco, retirement is too important to wing. I'll see you next time.